Perfect. Very good morning to all of you here. Thank you so much for joining us for the Thursday Highway webinars. This is Gautam here from Microsoft. I drive the VC and PE ecosystem here at Microsoft, and I'm really happy to host this session on a topic, of course, that I really love, which is fundraise. And we've got a great speaker today to run us through the mindset of a VC and what does it take for a startup to be prepared. Before I dive into the session and the speaker, a very quick high-level context. Most of you happen to be attending this session, through the Highway or the Emergex programs that you've been a part of at Microsoft. Microsoft has been working very closely with startups, early stage startups in India and in APAC. And as a part of it, we've been running these weekly webinars as well, the learning webinars, which allow startups to take a pause from their day-to-day operations, look at some of the niche topics that really require that constant learning from an expert. Fundraise, I would go ahead and connect it very similar to how you normally think on a day-to-day basis with respect to selling product to your customer, right? Because when you go ahead and sell your product to your customer, you go ahead and look at understanding what are the needs, how is the customer going to think, what are his pain points, or what does he need from you, and you go sell value to the customer. And very similarly, assuming your investor to be a customer and your investor pitch to be a sales pitch, and understanding what does he want to hear and what is the value you can bring in his thesis or in his journey is extremely important. And that is why we have this conversation with Rajiv from Arali Ventures. Thank you so much, Rajiv, for joining us today.
Pleasure is mine, Gautam. Thank you.
So Rajiv is a very, if I can say, a veteran in the startup ecosystem. And Arali Ventures has been a fund very primarily focused on B2B enterprise tech to a large extent. And if I remember, they've made about 9 out of 14 investments just in the SaaS and enterprise space. And Rajiv personally has been in the ecosystem for close to about a decade and a half. In the investment ecosystem, and I believe he comes with a lot of expertise and exposure, especially in terms of startups pitching to an investor. How does an investor react to a pitch? What goes well? What doesn't? How is the mindset of an investor? What are some of the top do's and don'ts? As a founder, when you approach an investor, especially from a B2B space. I mean, it's all the same, but since a lot of you today also happen to be from the B2B space, I think it's probably the best opportunity for you to have candid conversations with Rajiv. So Rajiv, thank you so much for joining us for this conversation.
Thanks, Ben. Thank you, Gautam.
Rajiv, I would like to set context for today's session, right? So it can be a freewheeling chat where you share your experiences on preparing for fundraise or the mindset of ahead of the fundraise on both sides. We have startups predominantly from the early stage looking to raise their seed to pre-series A. Most of them, of course, a few of them could be on either side, but most of the startups today on today's session would be looking to raise their seed to pre-series A. And I believe that is a stage where we have a lot to learn because our exposure to an actual investment closure is very low. So over to you, Rajiv, and I'll probably be on mute and I'll take questions. I'll moderate questions that come our way.
Got it. Gautam, just a quick check. Am I clearly audible and visible? Because in between you were freezing up, so I don't know if it's my connection or yours. I just wanted to confirm if I'm okay.
No, you're very clear, Rajiv.
Okay, great. All right. So good morning, everyone. Pleasure to be here. I think the last time I did the Highway to 100 program was actually in Goa just as COVID had begun in March 2020. So have fond memories. I think it's been my last professional travel out of Bangalore. So we've been in difficult times, and I hope all of you and your families have managed to stay resilient through these tough times. Gautam said I'm a veteran in the startup ecosystem. I'm probably not. I've been associated with the startup ecosystem for about 12 years, of which the first 4 or 5 years was from the outside as an angel investor, as someone who would tinker around discovering the startup ecosystem. But before that, I worked for about 16 to 17 years in the industry across consulting, finance, outsourcing, building businesses, running P&Ls. And then, through sheer accident, Angel invested in a B2B HR SaaS startup back in 2009 when I was very much at Infosys. And without knowing what angel investing was, this is way before the startup boom, way before even the smartphone internet boom in India. So, didn't know what an angel investment was, didn't know what a term sheet was, just, the infectious energy of a founder got to me and invested what at that time and even today is a material sum of money of 5 lakhs. And that kind of kickstarted me on the journey of my journey in the startup ecosystem. Learned a lot from that founder, saw the process. Series A happened 2 years later because I was an angel investor and, supposedly an experienced one because I used, some part of what I used to do at Infosys was relevant to what this company was doing. Did the ref calls, understood the VC process, saw astronomical growth, saw growth flattening, saw what happens, when the founders and the VC need to look for cash flow and profitability, saw the company going down, uh, saw the recovery basis on the show carried by the shoulders of energetic founders, almost a miraculous recovery. And 7 years later, in 2016, saw an exit through an acquisition by Aon Hewitt. The name of the company is CoCubes. Actually, some of you, Harpreet Grover, who's the founder of that company, has actually written a book. It's a good read. Definitely a good read for first-time founders, if not second-time founders. Along the way, Angel invested in two other companies, not big sum of money. I'm not a rich guy, but through sheer learnings, for the sheer learning. And 2013 is when I came out. I wanted to do something on my own, like a lot of you. But unfortunately, I was 39 at that time, I think. Yeah, I didn't know what to do. Normally, people have ideas but don't have courage. For me, it was the other way around. So I did the next best thing. I joined a startup. I evaluated 2, 3 startups. I ended up joining a UK-based fintech company that wanted someone to build their product and set up the team in India. And that's what I did for the next 2 years. That company was then acquired by State Street. And in 2015, and the reason I'm spending a little bit more on detail is you hopefully you guys get the different vantage points that I've had. In 2015, I set up, along with my current partner Arun, a firm called Syndicates, which was actually a boutique investment banking platform that would help startups raise money from angel investors initially, and then it became VC funds also. And we would take success fee in the form of equity because these would be small check sizes, 2 crores, 3 crores, for early stage companies. And we would work extensively with the founders in terms of, positioning, the deck, because that's the background we bought from our, sales experience. Not that we understood, and a little bit of the funding ecosystem that Arun and I had understood. So 3 years between 2015 and 18, we sat on your side, on the founder side, with the investors on the other side, angel and VC funds. Courtesy that, and thanks to that, we built relationships with pretty much all VC funds in India. We raised money for about 10 companies out of maybe about 20 companies that we contracted with. So decent hit rate. All those companies are at different stages. We ended up with minority equity positions in some of these companies. And then in 2018, we said, you know what? If we are anyway taking success fee in the form of equity and betting on the longer term growth and success of companies, why don't we just make this, why don't we just do this for a living and do a fund? And that's how we created a fund. Arali Fund 1 is we are first time fund managers, is a 40 crore fund. So, when you look at all the numbers that go around these days on TechCrunch and, Your Story and Tracker, these are small numbers. But for a first time fund, for folks like us who didn't have exposure to fundraising, we are, incredibly happy with where we have got to. We invest check sizes of between 100K to 400K in Fund 1 into enterprise tech companies, seed stage, which means B2B largely. We don't have any sectoral focus. We invest across sectors. Like Gautam mentioned, 9 investments today, 10th one in progress, and likely another 3 to 4 investments in Fund 1. Our investments range across SaaS, as you would expect. 4 are in SaaS. We have 2 in robotics that involve hardware, 1 focused on manufacturing, 1 focused on distribution. We have 1 more in hardware in the health, digital health space, which is a Norwegian company. And then we have one logistics, one fintech, and one more in the digital health space. That is our 10th investment. Arali Fund 2 is just coming together, which is, which will continue to pretty much do the same thing, which is seed stage, sharp focus, 20, maybe 15 to 20 investments, and continue to be overweight on B2B. The fund size will be larger because our check sizes will be larger, reserve a lot more capital for follow-on rounds. But what we do will likely continue to be the same thing. Right. With that, I think what I wanted to, the reason I, spent some time going through a detailed introduction was not so much to tom about what I've done, which is nothing great, but essentially to give you folks a sense that in the last 12 years, I've been an angel investor initially, saw the ecosystem from the outside, worked with founders, and then through CDEX, formalized and did a full-time role on fundraising with the founder team, shaping the story, learning what different investors thought, how partners at VC funds in India and in some cases outside India think, how do they work. Sat and also understood founders' fears, entrepreneurs' fears, their unknowns, their sometimes lack of complete knowledge on certain aspects, sometimes how smart they are. Was inspired by their passion, continue to be inspired by their passion, and then now in the last 3 years, been on the other side and investing into companies, right? And I think I think it's a very unique vantage point that we have, because I think our ability, when we say we are founder fair or founder friendly, which almost every fund these days talks about, I think we have a better basis to make that claim. And prior to that, spent, like I said, 15, 16 years, Anderson Consulting, finance, started my career at finance, post my MBA from IIM Bangalore, had a consulting stint with Anderson, and then 11 long years in the corporate sector with Infosys in the BPO business. It was very much a startup in those days, back in 2002, even though it was within a large company, and did pretty much everything that was there in the outsourcing and tech business. And then I told you guys about what I did. Got it. So Gautam, I'll dive in. So folks, what I have is I've got a set of slides to structure my thought. Otherwise, I will ramble, I guess, all over the place. And just to structure my thoughts and hopefully so that it's a little bit more productive for you folks, I've got a set of slides which I will walk through. So Gautam, I'm just going to share my screen. And Kabir just told me that folks use a broadcasting tool. So the way I would normally prefer is we can take questions as we go along. But if that's logistically complex, then I will create placeholders as we go along for questions. Does that make sense?
Sure, Rajiv. So yeah, I think you keep going with the flow, and whenever you want to take a logical break, you probably point out, and I'll come up with a couple of questions.
Got it.
Or if you believe I should interrupt and then ask questions, that's also fine. Whatever works.
No, I will do that. Sure. I will prompt you for questions. Just tell me when the document comes up. Is it up, Gautam?
Yes, Rajiv. Yeah.
Got it. Okay, great. So I'm conscious of the fact that so I don't know how many people are in the audience. Gautam, do you have visibility of that?
I'll
Okay,
we've got about 30 people, Rajiv. Yes.
Got it. So I'm conscious of the fact that while many of you are maybe predominantly in the seed stage, may still have not raised like an institutional round of funding, might have done angel. I'm also conscious that some of you might have raised an institutional round of funding. So for those of you who've raised an institutional round of funding, please, come forward and contribute or react to maybe what I'm saying. Either counter it with a counter view, or if you have examples, please do free to supplement it. Because I'm sure some of those experiences are possibly even richer. Okay. So what I'll try and hit, right, and is just for first-time fundraisers, right, to give you a sense. Some of this is very obvious stuff, but through my interactions over the last 7 years, I believe that a lot of us, I mean, when I was not part of the VC ecosystem, or a lot of the founders I interacted with really don't get it in terms of how does VC work? How do the minds of a venture capitalist work? What makes them tick? What doesn't? Right? And that's what I'm going to try and spend some time about. And also why it's important for you folks to understand, because I know lots of founders who will call me, my own portfolio company sometimes, who say, boss, look at that business raising 10 million. Look at what we're doing, right? And how can that company raise 10 million, right? Usme kya hai? What is there in that business, right? And it kind of reminds me a little bit of my campus days when people would go around cribbing, how did that person, how did he or she get placed in McKinsey or Booz Allen? But the reality is the market is supreme. That's something that all of us have to learn, right? But hopefully, just beyond that, overarching gospel, I'll try and share some aspects of VC that might help you make sense of the method behind the madness. And a lot of you may be aware, but that's fine, because for those of you who are not aware, this might be useful. And a little bit about the venture cap fundraising process itself for those of you who are first-time fundraisers, right? I mean, if you've done a fundraising process, this will be basic. So, what's obviously happened in the last 4 years, since the days I used to sit with founders and raise money, is there has been an explosion of funding sources for all of you, right? And not only has there been an explosion in terms of quantum, there has also been an explosion in terms of diversity. So broadly, if you look at it, you could bucket the various sources of funding into these 5. First is, of course, you bootstrap, you fund through revenues, right? That's also a legit source of fundraising. And that's the reason we said that that's possibly the definitely belongs in that 1 out of 5. Second is what is commonly known as the 3F rule, which is family, friends, and fools. So who possibly are standalone angel investors. And I suspect when I was angel investing, I was neither friends nor family, so I had to be a quote unquote fool. But I think all fools who invest in startups definitely become very wise, even if they started off as fools. Either by losing money or making money, wisdom anyway comes. Source 3 is angel networks, syndicates, accelerators. I mean, angel networks, Mumbai Angels, India Angels, those kind of guys. Syndicate, angel list, let's venture now. Accelerator programs, which range the entire spectrum, ranging from YC on the left to on one side of the extreme, to a lot of Indian-based accelerators, to corporate accelerators and the like. Then you have venture funds, which has seed funds, pre-A, Series A, the whole spectrum. And then you also have growth funds, strategic investors, and the like. Right. And the thing to note is that as you go across this spectrum, the motivation of investing and the return expectations differ significantly as we move along the chain, right? So with someone on the left, with friends, family, the motivation. With fools or angel networks, it's a lot about, yes, making returns, but it's also a lot about learning. It's also about surplus capital deployment. It's about discovering a new asset class. With return, return is always an objective. Investment return is an objective, but there are other objectives that are taking primacy. As you go to the right, as you get into the venture fund, which is institutional fundraising, their return becomes the primary objective, right? There are other objectives too, but return is the primary objective. And that's a crucial thing to understand. And investor sophistication also tends to increase as you go from left to right. As founders, it's very important to understand these differences, right? So let's talk about return expectations. This, you've heard this, right? But let's try and put some numbers around it. VCs, all of us as VCs, we go and fundraise, right? And I believe, right, and this is maybe you heard other funds tell you this. I believe it's much. We also are raising money all the time from our investors, right? So just as you have challenges in fundraising, you have learnings from fundraising, we have it all the time. And somehow I believe that as an individual, I believe that it's more difficult to raise money for a fund than it is for a company. But I guess grass is always greener. You might turn around and say it's the other way around. Because when I sell my fund, I'm selling the collective passion of my founders, and of course, what I bring as an entrepreneur to the fund, what we bring as entrepreneurs to the fund. So it's a little indirect. So building the correlation is that much more difficult. Having said that, when I raise money as a fund, when VC funds raise money, their expectation is to deliver outsized returns, right? Because return is the primary objective. Everything else is secondary. what is the conversation of a VC fund with an investor, right? Again, our investors are again twofold, institutional and individual. With individual investors, it is largely, actually, frankly, whether it's individual or institutional, it's about diversification. It is about if you have, $100 as the total kitty, the idea is $15 to $20 gets invested in the private equity asset class or alternative asset class. Traditionally, in theory, alternative assets also includes real estate, right? So maybe then that allocation is 30% to 35% of total wealth. And then the whole reason why they are allocating to alternative assets. Now, alternative assets can be real estate, can be VC private equity, can be hedge funds, derivatives, all let's say exotic instruments. But the objective of all of these alternative asset classes is to deliver a return that is disproportionately higher than what an investor gets from mutual funds, public market investing. So if those returns are in the 10 to, depending on which market you are, let's talk about India. If those returns are in the 10 to 15% average in good performing cycles of over a 10-year period, the expectation to get from the alternative asset class is anywhere from 25 to 40%, right? Anywhere. So that on an average, they are able to augment their return by about 400 to 500 basis points. That is 4% absolute, 5% absolute, because of the higher return that alternative asset classes give. Right. So if I have a 100 crore fund, the expectation is, see, some of these numbers, don't take it too seriously. And it's really about giving you a sense of the order of magnitude, right? So the return expectation sometimes will be 2.5x, maybe 5x. That will vary from fund manager to fund manager. It will vary from the kind of investors we are raising money. But on an average, right, just to focus on the order of magnitude, we're talking about a 100 crore fund. I want it to deliver 400 crores. That typically will translate into a 30% IRR over 5 years, right? In reality, the period will be 8 years, 10 years, whatever. For the sake of example, of a 30% IRR translates to a 4x of my fund size. That is my expectation. So then how does it translate into portfolio construction strategy, which means what company should I invest in, right? Look at this slide. The entire VC model to go from 100 to 400 crores is to have a portfolio, let's say, of 20 investments. I'm just keeping the model simple without fees and all of that stuff, because that point is moot at this point. So let's say individual investment in each 20 companies we invest, a fund invests in, 100 crore fund invests in, 5 crores each, get 10% equity, which means, give or take, the valuation is 50 crores, right? Now, scenario one, let's say the fund does its life, and scenario one is where, one second, I'm sorry. Gautam, is my slide still visible?
Yes, Rajiv, it is.
Okay, cool. So scenario one is, out of the 20 companies, all of them performed decently, which means 10 companies gave me a 4x exit. 10 companies gave me a 3x exit. Right? So my, so if my exit values are in that range, right? I suspect some of these numbers are wrong. So if 10 companies give me so I'm average investing, let's say 5 crores in a company. So if 10 companies give me 4x, that's 20 crores. So that's 200 crores. Yeah. And then, I get 150 crores, right? Which means I've got a 350 crore return. Scenario two is one company gives a 50x exit, one company gives a 30x exit, and 18 companies don't deliver. They go bust, they go zero, right? And this is a classic scenario of many B2C focused funds, right? Our funds are slightly somewhere in between, B2B focused funds are slightly in between these two scenarios. And so the reason, we're putting a wrong mark is what VCs typically look for is that at the time of investing, they don't know whether a company will deliver 50x exit or 4x exit. That we don't know. So the preference is, depending on the fund strategy, depending on the focus area, if we take a B2C focus fund, the preference is that each company at the time of investing needs to deliver 50x return, because that is the criteria for at the time of investment. So intuitively, logically, emotionally, can I convince myself that this company in this space with this founding team can deliver a 50x return, right? In my case, that number, let's say, is about 15x or 20x, right? And someone else's case, that number may be 10x. As the fund is larger, these numbers get to be smaller, right? So don't go with the absolute number. The spirit behind this is that as a company, you may be in a good business, in a good growth clip, and you may deliver a 4x return. But if intuitively at the time of investment, if I tag your business as something that is likely to give me a 4x to a 6x return, right, which is not bad. It is still very, very healthy money. As an angel investor, I will take it any day, right? Because I still get significant return, purely. But because the power law applies, and what is the power law applies is that everyone knows, or this is conventional VC logic, is that VC business, you could have anywhere between 50 to 80% of your investments fail. If you're investing high risk consumer, maybe it is 80%. If you're more mid risk like us, it's possibly 50%. Right? Fail meaning may not go to zero. In the B2B world in which I live in, it may deliver my capital back. It may give me 80% of my capital back. It may give me 2x of my capital back. First, for the other guys, it is write off, right? But because of that mortality, we need to ensure that every investment at the time, one thumb rule that a lot of VC funds use, some VC funds use, is at least let's say the seed players is, can every investment support the fact that it can return my fund value? So if my fund value is 40 crores, I'm investing about 2 to 2.5 crores in a company. Can every investment, which basically translates to 15 to 20x, right? So that's our, let's say, kind of threshold. And that's possibly one of the reasons when you folks hear reasons from funds about, okay, the market is not big enough, but you see it as a big market because you can still grow to, let's say, a 100 crore, 200 crore revenue, and you can support, let's say, a 4x, 5x return for the investor. He is the investor. That is, we are looking for that, whatever is my threshold return, target return on each investment, right? So each investment at the time of investing needs to support my target return of 20x or 50x, as the case may be. It pretty much is outsized returns, right? And this possibly is important to understand that every business is not VC investable. So kind of ask yourself, what is the kind of return profile that you can generate for money that you raise, right? If that return profile intuitively can support the kind of large returns that VC funds are looking for over a certain time frame, and I'll come to some of the other characteristics, then the time frame is also important because the business needs to have the ability to grow at a fast clip, because funds have a finite duration. I have a 7 to 10 year fund, which means that I need to, whatever I deliver the money back or I write the money off, that's got to happen over 10 years. There are businesses which may take 15 years to grow or 17 years to grow, and the lion's share of the growth may come between year 10 and year 15. In fact, some of the mature private equity funds or VC funds in US are going to a 15-year term, right? But leave that apart, right? Most funds in India are in the 7 to 10 year periods, which means that not only does it have to be a large market, not only does it have the ability to support this 20x, 50x growth, it also needs to pass the test that it can support that kind of growth and return in a 7 to 10 year time frame, right? So all of these tests have to be passed in order for a company to be VC investable. Now, of course, there are cycles, and I believe we are in one such cycle, which is kind of crazy. And some of the in a bit of a crazy cycle, some of these rules that I'm articulating may not necessarily be true, and exceptions will be there. You might have businesses that don't support these kind of returns also raising significant capital, but that I would attribute it to the craziness of the cycles as opposed to the fundamentals itself changing in the business. So what does it mean for you folks, right? What does expectation of outsized returns translate for all of you? It is a large addressable market. That is the number one criteria of all VC funds. They can tell you whatever they want. We folks can tell you whatever we want, but that is the number one important criteria. And that can vary, right? So for, let's say, a big fund which invests large sums of money, that's $1 billion market. For funds like us, it need not be $1 billion market because I'm putting smaller sums of money, right? Which means for me, it's got to be for funds in the, let's say, 50 to 100 crore seed fund range, maybe even up to 150 crores, it needs to be a 300 million market or a 400 million market, right? Which is, let's say, a 2,500 crore, 3,000, 4,000 crore baseline. I'm not talking about top line, right? The other things to ask about is the timing right? Is your market ready, right? Because very often you could be ahead of the market. If you're behind the market, you'll know it, but if you're ahead of the market, it's hard to gauge that. differentiation is a known thing. In terms of replicability, promoter mindset and ambition is a super critical criteria that outsized returns translate into. What do I mean by that, right? What every VC investor will look for is ambition. Vision, yes, but also ambition. Because along the way, along the journey of the company, different exit opportunities will arise, right? And one of the questions as a seed fund we constantly ask for ourselves is if all boxes are ticked. We invest, let's say, at a 5 million valuation. We get 10% equity in a company. But if this business reaches 25 million valuation, 30 million valuation, 40 million valuation, we are one investor. So the founders, let's say, have 80% in the company, investors have 20% in the company. At 40 million, if the company sells, it's a good sell, right? If it, let's say, happens over a 3-year period, 4-year period, it's still good returns. But it will translate into, let's say, a 6x or a 7x return for the fund. For the founders, on the other hand, 80% of 40 million is a lot of cash, right? I know all of us may come from different backgrounds, but I suspect, irrespective of the backgrounds, 80% of 40 million, or let me dilute that number by half, 80% of 10 million, or by 1/4, right? 80% of 10 million is 8 million, which is about 60 crores. There are 3 founders, 60 crores by 3 is 20 crores of cash. That's not trivial money. That can set us up, at least in India, in terms of cost of living today, that can set most of you up for life. So it's a good exit for a founder, but it may be an average exit for a VC investor, right? Also, because that deal will not be structured as an all-cash transaction, because the acquirer doesn't necessarily want to compensate the investor so much. He wants to compensate the founders. So it's most likely going to be structured as 40% upfront cash, 60% later. That 60% gets weighted. So chances are the investor is likely going to make 4x on that investment. Hence, promoter mindset and ambition becomes extremely critical, because we need to be able to gauge that. We may not be able to gauge that all the time. We need to be able. VC funds want to bet on individuals who want to build a company that can generate a valuation of 300 million, 400 million, 500 million, maybe revenues of 100 million, right? As the case may be. Whether it happens or not is a different ballgame. We need to be able to do this thing, and that's something that you can't wing this. I mean, maybe you will wing it, right? Some of you smart, you can act ambitious, but in reality you're not. But that's the other question to ask yourself. Do you have that kind of ambition? And there's nothing right or wrong, whichever way the answer is, right? It's absolutely fine to say, I'm fine if I can build a business that can sell at a 30 million valuation, 20 million valuation, and if I can walk away with 40 crores of cash, or 20 crores of cash and another 20, 25 crores of equity in the company that is buying me, that's good. Then just be cognizant that at least that is one of the reasons why you should not be taking VC capital. There are other capital you can be taking, or some smaller funds, or some in network maybe is what you should look at. So I guess that's the way in which you can translate this expectation of outsized returns and try and ask yourself these questions, saying that, does my business, do I as an individual and do we as co-founders, and does my product / offering / growth path support the kind of investor return expectations that we have, right? Let me take a pause there, Gautam, because I think I've covered one key theme of what I want to talk about, and then let's see if there are any questions that I'll take.
There are a couple of questions, Rajiv. So I'll probably ask this to you, very specific from a founder mindset, right? You did talk about the number of the multiples at which fund should ideally get the return from a few startups, because there will be write-offs, right? So a couple of questions on that slide when you brought it. One was, once a founder gets into his seed funding or pre-series A, when he brings the first VC, right? It's a constant game of fundraising, because for many founders who've not raised their first round, they don't know what it means from an investor relations. So what are your 2 cents to them? How will life be after they bring in the first set of external investors? Because you did mention that the only way, at least in India, that investors get money is the exits or capital gains or exits when bigger investors come in future rounds. So what will life look like for founders after they bring in the first set of external investors?
Sure. So I think there are at least I'm sensing more than one question there, maybe 3 questions there. One question is about what will life look like after investors come on board, right? That's the heart of the question. There were some other questions on, or at least you made a point, Gautam, on the only way investors can get exit is with other investors coming on. I'll just quickly hit that. That has changed in the last 3 years, right? 5 years ago, the only way an investor would exit is, the company gets really successful or other investors. I think what has happened in the last 4 years has changed the face of the startup ecosystem in India, right? There are three kinds of exits today. All have been demonstrated at scale and in volume, right? I mean, I remember when we were raising our fund in 2017, the biggest question we got, of course, the markets are doing very well. I can get 18% of mutual funds. What are you talking about 28%? That was one big issue. The other big question we got was that, yeah, exit nahi hai, right? And then Flipkart happened to Walmart, right? I mean, that's like, according to me, the watershed moment. And then we have now seen in the last 3 years the wave of unicorns this year specifically, but also number of exits that have happened, right? And exits of both kinds of business. The classic, what do you say, non-profitable kind of businesses, which are network-driven businesses like the Flipkarts and the Zomatos of the world, but also other strong cash-generating business like the gaming company that was bought, a couple of months, forgetting the name, Simply Play or whatever, right? So exits have come through acquisitions. Exits have come bigger funds buying out smaller funds. Exits have come through IPOs, and they will continue to come through IPOs and through other innovative vehicles, both early stage exits, late stage exits, right? So one of our companies, I mean, we are possibly one of the few seed funds in India who have an exit in our third year. One of our companies was acquired by a NASDAQ listed company called ZoomInfo, right? I mean, I can partly pat ourselves on the back saying that we are super smart in betting on the right founders. Yes, there's a little bit of that. But frankly, the environment has changed. I think the environment is enabling, greater velocity of exits, greater types of exits, right? So, okay, I've got that out of the way. We can come back to that. How does life change after investors? It really depends on the type of investor, and that I will come in the next slide. I have that's where you folks have to think a lot about what is the kind of investor you want to bring on board in the first stage. How much money do you really need? What's the right kind of investor at in your first round, right? Because and I think that question is very important in today's environment where there is so much capital available, and hence you possibly want investors who could, in early stage, you want folks who can largely be supportive of your view, your vision, and one, and two, be able to help along the way. Not in all aspects. Don't go in with expectations that VC funds will help in, this, that. They can't. You're the one who knows your business best. They can help, in ancillary ways. And I think the key is to be comfortable at an individual level with the partners of the VC funds that are investing into you, right? Chemistry is the most important thing. You've got to judge whether, they are people, they can be like you or unlike you, right? But does the chemistry work? Are you comfortable? Because if that is there, all issues or terms and stuff, other issues can be worked out. But more pragmatically speaking, how does life change? Honestly, not a whole lot, right? You possibly not a whole lot because investors are, running their own gigs. We are raising money. We are investing into the next company. You possibly will have a monthly call. I think the positive things is investors will force you to get a little bit disciplined about how you view your business. A lot of you for the first time will systematically review cash flows because there's a report going out once a month, maybe, which your accounting firm is doing. It's not that you're spending a lot of time, but at least now you're going to start to just look at it once before emailing it to the investor, right? Or uploading in a portal or whatever that might be. So yes, it will get you a little disciplined, but that's a part of growing up. And I think that's important because you've got to turn from being product visionaries to tech founders to business leaders, right? To people who understand P&L. So that is there. But two, I think the more nicer side of the change is you have some people who maybe they may not understand your business super well, but they are well connected. They maybe are just been around. They're older people, so you get access to some GDM networks. And something that I think founders don't explore as much is you possibly have a sounding board. I always believe the word mentor is a bad word because I don't think I can really mentor startups in areas that that there's only so much I understand. But I think the value of sounding board, if you have the right kind of investors, is humongous, right? And I think that's a big change that could come in terms of how life changes. You possibly have 1, 2, or 3 sounding boards once you get onto a VC fund. Different people, different individuals with different perspectives, right? That's the second thing. And the last thing is, the big change is that once a fund comes in, there is a return expectation, right? So the moment you raise money from a seed fund, you've got my 15x, 20x expectation that I will constantly try and steer you towards, right? The moment you raise your next fund, right? So every time you raise a round of capital, you got to recalibrate the length of your journey, right? The moment you raise seed, okay, great, because you can raise 3 crores from me, but you can still give me 15x in maybe 2 years, right? And the size of your company at that time, in point in time, maybe 200 crores or something like that, which is not that big. You make an early exit. But if you raise Series A of, let's say, 3 million, not sensationally big, now that guy has, let's say, a 10x return, so which means it will take you another 3 years, right? So, and that's where ambition becomes important. So that's the third change, that you're going to recalibrate every time you raise a round of money. You're going to recalibrate what's your journey with this company, and what are your exit plans, which are linked to your personal plans in life.
Rajiv, we've got a couple of very interesting questions. So if we can take a couple of more minutes.
Sure.
So I think one very specific from this slide, right? So the question is, how important is it for a founder to not just analyze the partner or the GPs, but also the size and the stage and the life of the fund? Because if the fund is towards its end of its life, let's say 8+1+1 or whatever it is in India, will there be a pressure from the GPs to have a quicker exit from the startup, and hence the pressure coming down to the founders?
Yeah, so no, I don't think it's important for you to analyze that. It's good to understand so that you know mentally where they are, right? Because but in reality, all funds will invest. They see, every fund also understands that I can't get return in 3 years, right? So funds will look to invest all their money latest by 4 years, normally by 3 years, right? In the first 3 years of the fund, and then they're on to raising their next fund. I mean, look at us. We've made 10 investments out of maybe 13 or 14. We are slow, right? I mean, we are the first-time fund managers. We are learning, and we're slightly conservative guys. I mean, we'll work at our pace. If we don't understand something, we can't invest. We don't invest. But so we are slow. We've made 10 investments in 3 years. We have 4 more to go, and we're just short. We're going to turn 3 next week, right? 3 years old. But we will be fully deployed by June of next year, right? And we have already started Arali Fund 2. And which means that I have a 7+2. My fund is 7+2 years. So I know that my last investment has to happen within 3.5 years, because 6-7 saal to chahiye. So you don't have to worry about that. They are worrying about that. What might be interesting for you, in all honesty, is okay. I think Rajiv is a good guy. If you do, unlikely, but if you do, so I like him. So I think I'd like his support. Then I think for you to think about is, okay, what stage is he in his fund, right? He's in fund year 3. And I think he's talking about raising his next fund. So really, in the next 1 year, Rajiv is going to have very little time to spend with portfolio, right? I mean, this is a secret. Don't quote me on it, because we are going to be out fundraising. So the amount of time that is available, if you are expecting some of the other stuff, becomes less. But that's where it comes down to individuals, right? If you're the kind of individual like me, I will always find time for my founders, because they drive my success, right? So you got to find investors like that who put you at the top, right? And remember that also, and Gautam and Kabir might say that this is a definite plug-in for me, is small fish in big pond versus big fish in small pond. You pick what you want. Pick the brand name. If you want the brand name, then you become a small fish in a big pond. If you don't want the brand name, you become a big fish in a small pond, and you got recall, you got support, you got access to resources, right? I kind of digressed a bit, but hopefully I did answer that question also, Gautam.
Absolutely, Rajiv. So there's one final question before we get back into the flow. The common question with all founders is, more money today is always great. So what would you, as an investor, as an institutional investor, advise founders when it comes to what is the ideal runway to factor, and what is the ideal dilution to have in your first early stage fundraise, say seed round or up to a pre-series A? Something that is not a red flag for institutional VCs like you.
Got it. So see, we ourselves are seed investors, right? So we are coming in very early, sometimes with angels or sometimes no angels. We are like, we are like the first external shareholder in the company. But in general, if I would answer the question, that seed rounds, whether it's angel, seed funds like us, whatever, should be your total dilution, depending on how much capital you raise, should be in the 10 to 20% range. Not more, can be less if you can swing it. Of course, less is great from your perspective, but it's got to be in that range, right? The moment it starts to go north of 20% is when it's not going to be a red flag, but basically Series A will come in at 25%, let's say. Then you're down if you've diluted 25 in seed, and some decent companies done it, but you still may choose to dilute 25 at seed, but your seed itself is 2.5 million, 3 million, right? But if you're in the half to 1 million, which is where most seed will be, maybe even lower than 500,000, then you've got to be in the 10 to 20% range. Otherwise, you're down. If you're down 25% in seed, you're down 25% in Series A, and let's say there was a pre-A at 10%, some convertible that happened. That means you're down to 60% at the end of Series A. Then what happens is, if the good news is your business is continuing to grow, if you're not, then anyway you're in trouble. But let's say your business continuing to grow and you come up for Series B, then the Series B is going to say, how much is still left in for the founders, right? If it's 40, it's okay. But if you start to get to 30, then they start to ask the question. Then they will say, can I buy out some investors? Because they want you to be fully vested. They want you to have a material share because they want to come in at that stage and they want 10x on that. So you have to be motivated. I told you, right, that your journey gets recalibrated. Your journey gets recalibrated to zero every time you raise a round of capital because you got to deliver that fund's returns now. So yeah, I mean, I don't know if I answered the question, but that's my view.
No, absolutely. And from a runway perspective, taking the example of a B2B startup, because assuming that there is definitely going to be future fundraisers, what would you suggest is the ideal runway they plan for when they go for a seed round?
Yeah, seed B2B 18 to 24 months. Seed B2C 12 months, I would say.
Got that. Fair enough, Rajiv. So I think we'll probably continue with your flow, and I'll keep coming up with these questions.
Sure. So right. So we talked about return expectations, right? So basically, you ask the question. With all that, you kind of ask yourself the question: is VC right for you, right? So like I said, you got to ask yourself the question: should you raise VC at all? Please ask that question first. Which means, are you that team with that kind of ambition? Are you willing to stay on the ride for that long? Can your business support that kind of growth? Is the underlying market opportunity large? Does your product or offering support quick growth? The speed also is important. It's not just the quantum of the size of the market. It's also the speed of potential growth. And you got to ask yourself, which is a very important question, is sometimes you might say, okay, I can raise smaller amounts of capital. But the opportunity cost, sometimes capital is needed just to grow faster, to build a network effect, to eliminate competition. So that's the other question you got to ask, and that's where VC can sometimes play a critical role, right? Especially in B2B businesses, you could say, hey, I'm going to generate cash. I need a working capital loan. I'll get it from a few angel investors. I'll get 1 crore. I can keep growing. Revenues will come. Yes, it will come, but do you want to grow faster? Why do you need to grow faster? Maybe if you don't, this competition is going to grow faster. You may lose talent. There's so many different connotations, right? And these days, I think from the last 3 years, having a VC on board is almost becomes an essential thing to attract good talent, because the talent is saying, are you VC funded or not? Which is funny, but I can see why that happens that way, right? And the last point is alignment of VC and founder objectives, right? And I shameless plug-in, but I very genuinely believe in this because I sat on the founder side pitching to large VC funds. I believe small funds have a better fit, very clear better fit for founders who are playing businesses with and who are happy with smaller outcomes, right? So if you're playing in a $400 million market or you're playing in a $500 million market, don't waste your time with Sequoia, Accel, and Matrix, right? And even if you're on the border of that, right? And so that's where the smaller funds work better for you. I already talked about evaluating chemistry, right? you got to trade off brand name versus, I won't say support, brand name versus attention, right? With the bigger brand name, you get a lot of support, right? As in, obviously, they have access to lots of resources. They'll have some product management guy, they'll have legal guy, they'll have finance guy. You come to Arali with a 4-member team, you don't want to have all of that stuff. So maybe you get a lot of support there, but I just don't know how much attention you get, right? And there's just a lot of bells and whistles. It's a big company versus a small company kind of thing, right? So that's again another judgment that you have to make. Obviously, being an Accel funded company means something. So there's no way I want to stand here and say that you should always choose a small fund like us. But there are going to be circumstances, there are going to be businesses, there are going to be founder types where you have to evaluate and make that decision. Okay. I'll quickly jump on and I'll try and cover the rest part quickly so that I just open it up to questions. Let's now moving a little bit into the process, right? 5-step process, if you will. I mean, they can be 10 the way. Plan. This is your fundraising process, I mean. Plan, research, structure and organize, pitch, negotiate, close, right? And think of it as an ongoing activity. All of you know whether you're raising multiple rounds of capital or this whole arrow that comes back here, right? Is just the multiple pitches you're going to be doing. And every time you pitch, every time you get some feedback, you may need to research more, you may need to reorganize or refine your thinking a little bit. So keep listening to feedback. Don't fundamentally change, but keep incorporating feedback, right? So, but budget for time and effort, right? It is not trivial. It is not trivial, and I don't want to call it a full-time job, but it needs full-time attention. And I have seen many founders who when their response times are poor, it doesn't mean that it reflects poorly on them, because I understand founders are busy, but it just to me means that to me money is very central to the business, whether it's revenue or fundraise, right? So, and that's primary. So the CEO and the founder has to value that the most. To me, it kind of says, where is the priority going to? If a founder tells me I'm really busy with the product, give me 2 weeks, I'll be sympathetic, but it tells me something about where this person is oriented, right? Nothing beats a structured process. Be very open, truthful, be very honest to yourself, and intellectual integrity is super critical. I'll come back to it on the pitch side. From a planning perspective, set milestones for the business. Gautam spoke about runway, right? Saying that, okay, 18 months, how much money do you really need? Plan the growth of your business, say what milestones am I going to hit, and then reverse engineer to say how much money. Very often founders today in a capital surplus environment are saying that I want 5 million, I want 3 million. You will not believe the number of times I can look at a very basic 1-tab spreadsheet and tell the founder that you're saying you want 3 million, your business needs only 1 million, right? So be clear about that, right? Work backwards rather than just say I want a number, right? And have a grasp on their numbers. It's your plan. It's not your CA. It's not your CA's plan. It's not your banker's plan. A big no-no is, let me check with my finance. Let me check with my CA. Let me check with my banker. Let me check with my co-founder. I need that answer. To me, not understanding numbers is not having a grasp on numbers doesn't mean you don't know finance. It means you don't know your business, right? And being frugal at seed stage is important, right? We want to fund what is essential for the business, right? So definite no-nos are inflated costs. Unrealistic revenue targets are a problem. Higher than norm promoter salaries are a problem. Looking to exit existing investors like angels very early in the day is also a problem. Spend a lot of time on research, which I said and when I say research, it is both. It is both on your business and on the investors that you're pitching to, right? It's so while the slide says it is not just on your market and product, that is important. You've got to have a clear view on what is this market opportunity, where do you fit, but it's also about potential investors, right? Thinking through all the stuff we already spoke about. What is the type of investor on that spectrum from left to right that you want? What is the return expectation you can deliver to him? What is his or her staying period, right? 6 years, 3 years, 8 years. Ask these questions. Very few founders ask me the question, when do you want to get out, right? When it comes to the investment agreement, every investment agreement has an exit period, which is typically 4 years, 5 years, 3 years sometimes, right? But ask that question upfront. When do you want to get out? What's your return expectation? How much do you want to deliver on your fund? How much do you want to deliver on on our company, right? If founders ask me, I often want to have questions. I'm just not prepared, for these kind of questions, right? Identify partners. VC firms are small shops. However big they are small shops. They are run by partners, i.e., individuals. They're not very institutional in nature, barring for a few large ones, right? So their history, their track record, what makes them tick, what makes them tick. At an individual basis, do that research and develop a hypothesis as to what are your expectations from an investor, right? And have realistic expectations. Investors can only do that much for you. So develop a hypothesis on what is the kind of investor you want, how much brand signaling you want, how much support you want, how much attention you want, and most importantly, how much of a sounding board value do you want, right? And believe me, an impression can be created by just homework and planning that you can do on some of these aspects. If I have a founder who asks me some of these questions, it will definitely create some attention, and I will pay a second look to that pitch, to that conversation. Whether or not we invest or others invest doesn't matter. Let me pause and see if there are any questions before I move to the final 3 slides.
We can proceed, Rajiv. We'll come back to the questions.
Okay, all right. So on this side, we spoke about plan, we spoke about research. Now let's talk about structuring, right? This is also important. Start early. Don't have to wait. Please don't wait for your fundraise process to reach out to your VCs. What VCs love, absolutely love, is to be reached out to, saying, hey, I'm so and so. This is what I'm building. I'm not looking to raise money. I want to have a conversation with you. Want to get some thoughts, not about fundraising, just want some thoughts, and I want to stay in touch with you, right? That's a super cool way to build a relationship. Now, a lot of you may turn on and say, "Yaar, koi VC respond nahi karta." That's the nature of the beast. It's you've got to invest that time. And the reason is VCs invest, especially seed VCs, but most VCs invest in founding teams and not as much as the idea. We have a process at Arali where if a founder is interesting, but the business is not, we list it down. We have a separate tracker that tracks such founders. We have a process where we reach out to them every 6 months saying, what's going on? How are things? Right? Because either we will be proven wrong, saying that we were stupid and we didn't realize the potential of that business idea, or as it happens in many cases, the business will pivot or the founder will pivot into something else. And it is that point where we are already vested, we have a relationship. Chances are, when he's looking to raise money, we are already in a different conversation and we maybe have an ability to influence that fundraise or get into that investment even without quote unquote competition, right? So VCs are invested in building longer term relationships way before you do a fundraise. You are vested in it for a different reason. You'll get feedback, you'll build a relationship. You may get some insights, right? If you build a relationship. You got to manage fundraise as a sales process. There's relationship, but it's also a process. You need discipline, you need a spreadsheet, you need to monitor this. I've seen within my founder companies, out of our first 6 investments, 4 have already raised a round of capital, right? And we've been very involved in those processes, but I can make out the difference between those who run it as a process and those who don't, right? And it makes a big difference. Leverage networks, seek help, give help. If you build a relationship with a VC fund, refer friends to them, give them a deal, right? I will always remember folks who refer leads to us, right? Focus on engagement, right? Don't see a conversation with a VC fund as a binary end conversation, right? If you go in saying, I'm looking to engage, I'm looking for feedback, I'm okay to hear no, but look to engage, look to get feedback. Let's talk about the pitch. That's kind of one of the most talked about things. So, that's the reason we focus a lot more on planning, researching, and organizing and structuring. But yes, the pitch is super important. Why is the pitch super important is because VC funds are hit by so many pitches, so many conversations, so many emails that there is exhaustion and there is limited attention span. So the pitch is super critical, right? Few learnings basis both our last 7 years of experience is that the pitch is always about the business. It is not about the technology. Please remember this. I mean, I don't know if it is in the spirit of finding jargon or what. Most often I can skip 6, 7 slides before I understand what the business really is. I struggle. I just won't understand what the business is because there is just so much of tech words written. All I need to understand is this is the industry, this is the process or the value chain. It is this part of the value chain that I seek to disrupt, change, augment. This is how I seek to do it. If you can tell me that story in the first 2 slides, 3 slides, everything can come after that, right? Because also remember that on the investor side, 60 to 70% people may not necessarily understand deep jargon on tech or deep jargon on your industry. You've got to dumb it down for them, right? Business traction is worth a million slides and words, so no two ways about it. I spoke about this already, getting your articulation right? It's that what is the problem you're solving? What is the part of the value chain that you're disrupting or augmenting? What is the value for customers? Why is the time now right? First 4 slides, if you cover it, you got attention. Forget attention. You got them to understand. You're helping them understand quickly. I love a pitch where I spend the least amount of time to understand what this pitch is about. And that least amount of time is often 2 to 3 minutes. If in 3 minutes, which means first 5 slides I've skimmed, I've got a sense. I already like the clarity or the so-called implied clarity of the founder, right? And then I invest. 3 minutes can very easily become 1.5 hours, right? It is just how you manage that pitch, because very often pitches are sent by email. You've had a quick conversation. In that conversation, the guy is distracted, so you're following it up with the email. Hence, that presentation, that PDF, or a one-page document that goes out is important, because that is what is read without context very often, right? Be clear on competitive landscape and keep that very simple, right? Underplaying competition is a warning sign, yes, but also remember that competition need not be just competitors, but it could be what are alternatives. Internal tools may be an alternative, right? So do cover that also. Demystify and de-jargonize. Please don't throw technology terms. If you've done your research, you'll realize that Rajiv is not a tech guy. Yes, he built a product, but he's not a tech guy, so he won't understand. And throwing technology terms is a distraction. Super jargon is a distraction more than anything else. He will ignore either because he doesn't like it or because he doesn't understand it. Either of the two. There will be both types of investors out there. It is selling, but a key part of selling is listening. So keep that in mind. In a conversation, very often we get a quick vibe saying that this is a guy who's not listening, who's so wedded to his idea, so wedded to his business that he's not listening, right? So flexibility is a key criteria. Ability to adapt is a key criteria, and VCs look for it in early stages of a conversation, right? And saying, I don't know, it's a good point. I have not thought about it. I think it's important, but I will figure it out. And I think I'll figure it out, not now, but after 6 months because of reason ABC, is a perfectly good answer, right? Being honest, being transparent is a super differentiator. I can assure you it's a super differentiator. Not having answers is sometimes a differentiator, but of course, the way you say it and the way you acknowledge it and the way you say you're going to mitigate the lack of knowledge, is also important. Last part, which is closing, which is, you pitched, you got interest, you're getting close to a term sheet. Having sat on both sides, I believe don't be valuation centric, be capital centric. In early stages, valuation is a derived number. Like I said, 10 to 20% is the range. You know it, VC investors know it, seed funds know it, angel investors know it. Focus on getting the amount right. Set yourself up for that 15, 18, 24 month period. If you set yourself up for 24 months and you believe that's 1 million, it is 1 million. You believe it's 500,000, it's 500,000, right? And then it's 10 to 15%, 10 to 20%. So if it's 750K, you broadly are on the, let's say, in the 10% spectrum, then the valuation is, what's that? That's 7.5 million post money. If it's on the 20% side, then your valuation is 3.5 million or whatever that number is, right? So don't boil yourself so much on valuation. There are ownership targets that funds will have, seed guys have. Your range in seed is 10 to 20. Focus on amount of capital, because that's what you know, right? You know how much you want, you know how much intuitively, emotionally, scientifically, rationally know how much you can dilute. With that, the valuation is a derived number. Don't kill yourself on valuation. Understand and pay attention to terms and conditions. They're important. Start educating yourself. You can't go into a term sheet and start figuring stuff out. At that time, Googling stuff, talking to your lawyer. Seek advice, guidance of ex-entrepreneurs who have raised capital before. They are the best advisors. Also, please remember when doing that, seek guidance of people who are in similar stages or just past one stage. Very often we have founders who take feedback from, let's say, a Series C fund, a company that is past Series C. So, that founder has evolved, his terms have evolved, his notion of bargaining power has evolved, right? So sometimes you get wrong feedback if you get advice from a founder who's at a very different stage. Don't penny pinch on legal advice. You need a lawyer. But again, it is very important to choose the right lawyer and be wary of lawyers who will debate every clause, because there's no point in debating. You got to choose your battles. Pay attention to compliance. Super important prior to fundraising, right? Do not ignore your accounting. Folks, you're running a business. You are not just building a product. If you have taken money, if you don't, you would be surprised how many times we get into due diligence, we found that revenue has been booked, invoice has been raised, GST has been collected, but GST is not being paid because the founders believed that, yaar, thoda working capital ka problem tha, wo baad mein de lenge, right? These are huge issues. You've got to pay attention to compliance. When I run into founder teams who say, yaar, all this our accounting guy was looking at, hence there are slip-ups, red flag for me. Huge red flag. There have been deals where during due diligence, when we have seen this kind of founder behavior, we have, set the deals off, right? Don't penny pinch on good advisors, meaning accountants, company secretaries. Do not penny pinch. Spend a little bit of money, and reach out to folks like us if you want help on, who are good folks who come at good price points and things like that, right? And of course, there is many a slip between the cup and the lip. The deal is done only when the money is in the bank. That's one of the most important things to remember. It's never a done deal till your investment agreements are signed, at least, right? Once your agreements are signed, the money will typically come. Yeah, I mean, that's pretty much it. I will pause there. I would love to get feedback, reactions, not just necessarily questions. But also, you can get my email subsequent to this discussion. Please feel free to reach out. Like I said, we are in the business of investing, would love leads, would love to understand about your businesses, would also love, in leads into other investment opportunities.
Thank you so much, Rajiv. I think a lot of value bombs here. So I have a few questions lined up for you, right? So before we probably wind up the session, a couple of quick questions for you. One, you did mention in one of your slides that start early, right? Even if you're not ready for fundraise, start connecting with investors, in giving them updates and learning from them, warming them up before you actually pitch for the fundraise, right? So there's a question around that, what do the decision makers within the funds prefer, right? Do they prefer a lead coming through an introduction or a person they know well outside the fund, or would they prefer it coming through their analyst teams within the fund? So I know it's a tricky question, but that's how the founders think, because they're usually stuck on, should we seek someone in the network who can connect me to a Rajiv? Let's say, for example, a Latika or a Gautam know Rajiv well. Can I ask a Latika or a Gautam to write up a few lines about working with me to Rajiv? Will that strike a better chord with Rajiv? Or should I go through some analyst in Rajiv's team who analyzes and then pushes it to Rajiv? So which would be a better choice?
I'll give you the honest answer. And this is based on human behavior, nothing to do with VC funds, right? Is that so the answer is different between small funds and big funds, right? Big funds will have large teams. There's so much more deal flow. There's so many more companies that they're seeing. So, the answer might vary a little bit. In Arali, we are 4 of us. There are 2 partners and we have no analysts. We have 2 principals, right? Which means people who are also more mature. Most of us are at least entry-level decision makers. Final decision makers may be partners. So in a small fund, it may not matter that much. But with a big fund, if you want to get attention, any day you want to go through a network. You want to go through a referral, because when it goes through a referral, you are obliged to respond, right? Even if you don't like the company, maybe you're obliged to have a conversation. Even in a small fund, if you want to get partner attention, I believe that frankly, if attention has to be got, you will get it, right? It doesn't matter. So that is the first level to the answer. It doesn't matter if you go through an analyst or whatever, you will get that attention. Like there are deals which come just through a cold email. We have a contact us early at Early Ventures, and there are those deals also get attention because they go into a triage box. One of us sits and reviews it, and they will cascade it up. But you might miss. Yes, obviously you will miss a few. So then any day better to go through an existing investee company of that fund, or let's say other people like in Gautam, in your case, let's say using Latika's example, because if that comes from Latika, I'm obliged to respond, right? You won't believe the amount of time that we, as partners have to basically spend in responding to, let's say, leads that come from referrals, right? Sometimes it even becomes an irritant, because I take one look at the deal, I know I'm not going to be investing in it. But depending on whom that came from, I may be sometimes even, that person's not asking for it, but sometimes I'm even forced to have a half-an-hour conversation with the founder, even though I know what it is, right? But philosophically, we believe is slightly different. We're a small fund, right? So maybe we can't afford to be that thing. We believe we learn from every conversation, right? And hence we are, what do you say? We over-invest in conversations, right? So I might know that this company may not result in an investment, but who knows? That individual may be someone who may turn out to be interesting, and we want to track, even though that business we may not be wanted to invest, or that individual. If I'm just, our philosophy is that you spend that half an hour, you give your perspectives on why. Very often I share my perspectives on why a business is not investable, and they may like it or not like it, but hopefully they'll remember, and then he or she may give me a lead, right? So yeah, long answer, but short answer to your question: if you have a choice, go through a network. That is the best way to get attention.
I'm on mute. So two more questions, Raji. Again, very interesting questions from the founders, right? Can really feel. This is specifically to one of the slides where you mentioned about the big fish and the small pond. So the question is specifically to from a startup that prefers being a big fish in a small pond, right? His question is, I'm not really concerned about the brand at the seed fund stage, because the growth is extremely important, growth and attention. How do you evaluate the best investor for you, or the best small fish or small pond, to be a big fish there? Because let's say there are 10 funds that, are good small ponds. How do you evaluate the best pond for you?
Sure. Good question. I think it's a really good question. 3 things, or maybe 2 things. Spend some time researching. Look at what they write on the internet. Sometimes it may not be that much, but get a sense from them, right? Look at their past lives. Today there is so much out there in the digital medium that you can construct a personality type basis what you find on the internet, in blogs, in websites and stuff like that. Because when you're evaluating which, let's say, small pond you want to be part of, you really want to get an insight into the kind of people these funds are, right? And that you can construct digitally. Look at their track record, not just, let's say, when they ran funds. Look at their LinkedIn, see what they've done in their past life, see where they are from, frankly. I mean, if a founder tells me, hey, I'm from Bangalore, I grew up in Malleshwaram, that is a call, right? So it's important sometimes to see, where did this guy grow up? Where did he go to school, right? He might be 25 years older than me, right? But if I went to National English School, which is these days called National Public School. As a founder of National Public School, I just have that certain curiosity, right? Because my son studies in NPS, and suddenly saying, wow, this guy is like 10 years older than my son, and look at the maturity with which he's speaking. So research that, right? And get a sense. You will get a sense of the personality, right? You will get a sense of the personality. Number 2, reach out to figure out which companies they've invested in, or let's say past connects that they've had. If you know them, great. Give them a call, have a chat. If not, reach out on LinkedIn to them, right? Reach out to my founders if you were looking at me, and say, I'm so and so. Here's where I am. and you'll get a really honest opinion from them, right? And they'll say, these guys are good in these, but if you're looking for these, maybe Arali is not the right fund for you. But anyway, have a chat with them is what I suspect most of my founders will tell, but different founders will tell you different things. That's it. I think these two things are simple ways in which you can equip yourself with better information to make that call.
And what kind of support, because there's also something you mentioned, what kind of support beyond capital should you potentially expect from your seed investor? Whether it is a different case when it's an angel, it's a different case when it's a seed fund. But as a founder, what is it that you can go in with an expectation?
I think that's I don't want to answer it generically because it's a tough one, because I think it varies fund by fund, individual by individual. I'll give you what is our position today, right? And hopefully we can extrapolate a little bit from that. In our fund one journey, what we have realized we are good at in terms of supporting founders is largely three things. Area one is strategy and positioning, sounding board, right? It doesn't matter what the business is, what the industry is. Both Arun and I have been consultants in the past. So when you have a career in career in consulting, and when you have built businesses in very, starting from scratch, we did that in Infosys BPO, fighting against the big IBMs and the Accentures of the world. There is certain perspective that you acquire. So strategy, positioning, product positioning, customer segmentation, thinking through some of that stuff. Where do you start? And so I'm just putting all of that in the one bucket. Strategy and positioning and sounding board, number one, is I think where we have delivered well on. And we have actually done a proper feedback with our founders, and we keep doing that. Number two is future round fundraising. Now, given our background of CDEX, where we were investment bankers, given our relationship with VC funds, we are able to add material value, not just in connects, but in saying that this fund is not a fit, this fund is a fit, able to steer the conversations with future fundraisers, right? So that's number two. Number three is financial management, attention to compliance, attention to how do you set yourself up for future fundraising, right? And what do you need to do within the organization? That's number three. And number four is go to market. I think given our traditional networks, given our LP networks, our investor networks, which is very largely in the enterprise world, spread across the world in different industry segments, our ability to open up some go to market threads, this is there, and we've done reasonably well on that. Right. So I think these four we have done well on, and we intend to continue focusing and building on these capabilities as the fund level. What we have not done well in fund one, or areas where I think our companies need support, but we have not been able to support, are the following. Hiring. Tech talent hiring is something that typically funds will not be able to help you. Okay, I won't say that. I'll say what we have not been able to do. Area number two is this whole thing around early stage digital growth hacking, which is SEO, digital marketing, just that whole thing, which just comes with some founder new age entrepreneur capability, right? That's something we've not been able to do super progress on. Number three is I wouldn't say product management, because that sits in the strategy and positioning. That's we are able to add value on. But just product marketing, early stage, figuring out product market fit. Again, we work through frameworks and stuff like that. But we haven't built three companies or in the product space, if you will. Some of us come from a services background. So I think that is another area that we have not done a great job on, right? So you could use this as a thing. Now, as funds evolve, right? Now, as we go into fund two, we have identified these areas. So there are three and two other areas we have identified where we are not good at. So going into fund two, we are consciously onboarding individuals who are either going to be investors in the fund or may not be investors, who will be our advisors / venture partners, and we will have commercial or non-commercial arrangements with them. And we will have a point, our intent right now, because core team will never be able to afford to hire so many people. We are likely to have between 3 and 5 individuals who will support these areas. Right, and they will be our go-to people, right? And they will be part of the fund team in some capacity, and they will engage with our companies. And if then they may engage even commercially with the companies after once comfort is built and stuff like that. So I guess that's the way we look at it, and I guess different funds will look at it, in different ways. You will have some fund where there is a founder who's great at growth hacking because he was an ex-founder, he's built 2 consumer companies. So then that capability is part of the core capability of the fund. But every fund is going to have some core capabilities, the way I articulated, and some non-core capabilities which they either don't have or we'll figure out some ways to try and bring to the table. But I want to make one overarching comment, right? I think that, so the more sharp the areas of support that you're seeking, the more unrealistic you're being. The more generalist the area of support you're seeking, the more realistic you are and the more likely you're going to get it. Sometimes when you have companies who say, I want this help, I want that help, I'm like, oh, then this is not the person I need to be investing in. He's looking for too much help, right? Because let's face it, I as a fund run my own business, right? So everyone's got their own thing going. So you got to strike that balance.
Absolutely, Rajiv. And one final question. This is more very specific towards Arali and your thesis and your approach. Because you're investing in the seed stage, which could mean it's mostly the first checks, and it could be with angels. It may not be with angels. It could be just Arali alone. What is the mindset of Arali or you as a venture partner when it comes to evaluating a deal where you may have to co-invest with other funds or other angels? How do you see that? What are some of the no's for you?
You're breaking up, Gautam. What are some of the last part?
What are some of the red flags or no's for you when you have to co-invest in a deal?
Okay. So out of my we're doing our 10th investment now. Out of our 10 investments today, 7 are, let me see, 1, 2, 7 are actually co-investments, right? Because we're a small fund. We participate in, sometimes we invest between, our median check size has been 2 to 3 crores, but our round sizes have been, so wherever the round size is 4, 5, 6, 8, 10 crores, obviously there are co-investors, right? So 3 we have done independently, 7 we have co-investors. Of the 7 that we have co-invested in, we are either leads or co-leads in 4, right? And in the other 3, we are neither co-leads or we are not leads, which means we are, we're just part of the mix. There is a larger investor who is the lead, right? What I'm trying to say is we have worked in all capacities. We are equally comfortable in all capacities. We have no issues. We have no challenges. What specifically are the red flags? Good question. Have we had a situation where we have not done a deal because we were not comfortable with our co-investors? Actually, no, right? Are we uncomfortable with, I don't think there's any red flag. I mean, each fund and individual will have some biases, okay? No two ways about it, right? So there may be some fund or network where I have not had a great experience with. I might have a bit of a negative bias, but it's then upon you to convince me to get over my negative bias, or you get convinced by my negative bias. That occasionally will be there with everyone, right? But that's an outlier. The one thing that might be a bit of a flag for me is if there is an angel network that's coming in, or there are many angels who are coming in, right? If the cap table has too many participants in a round, then I'm going to say, you know what, can we do something? Then, I might come to tell you, let me talk to 1 or 2 other funds. Let's see if they can invest instead of getting so many individuals, right? Because I know it's just administratively complex to manage so many shareholders and, stuff like that. My other red flag can be, that whether I'm a follow investor or a lead investor, if my co-investors, whether they are lead or otherwise, are asking for, so let's say the example where someone else is leading and we are just participating in the investment, if there is too much of disproportionate rights on the agreement, too much, there will be some rights that a lead investor has that we don't have. But if there's some seriously disproportionate stuff, then I might worry about it. I will push back. Or very often we talk to the lead investor directly and say, hey, this is what I'm not comment. We will sort it out. On the other side, if I am the lead investor, same thing ulta. If the angel investors are pushing for extension of all rights to them, which makes the administration of our post-investment administration very complex, then I'm going to likely to be push back on some of that. But most of that is administrative stuff. There's not, like I said, there's not been a single deal where we have either pulled out or other than that one conversation where we have encouraged founders to say, don't go with these guys because we're going to have too many shareholders on the cap table.
Perfect, Rajiv. I think, it was mainly from that angle because a lot of angel networks during this stage may not necessarily invest as one entity. right? Or as one SPV, they may end up investing or getting all their individual members on the cap table. I think it was primarily from that angle that this question came in. But thank you so much, Rajiv, for 90 minutes of value bombs. So I would probably want you to just probably throw in a couple of closing thoughts that you want to leave our founders with, and especially one thing I keen to know is what is the ideal profile of a startup or a stage of a startup or a sector of a startup who should write to you for an investment from Arali?
Okay. So Gautam, no closing comments per se. Arali is a great fund, so please reach out to us. We're good guys. We'd like to think we add some value. But I think most importantly, I think we've built businesses over the last 18 to 20 years. So shameless plug-in, I think our first fund is doing very well. Our second fund, where our initial check sizes in fund one has been 300K to 400K, 100K to 400K. In Fund 2, our check size is going to be $500,000 to $750,000. Fund 2 is going to be up and running early next year, but Fund 1 is going to overlap. So we're going to be continuing investing. It's going to be a seamless transition. So please reach out. In terms of the ideal fit and stuff like that, no sector focus. So there is no specific thing, a sector focus. Yes, we are today B2B. We will continue to be overweight on B2B. So in Fund 2, we will do B2C, but we will be overweight on B2B because that's our heritage. That's what we understand. Even in B2C, I think we struggle with revenue businesses that don't have a revenue model, right? So we look at B2C businesses, but if there's no revenue model, which means there's deep capital, small fund doesn't cut it for us. So that's not likely to play. We don't invest into businesses that we don't understand. I mean, actually, it's Arun, my partner, who has put this view in my head. Beyond a point, if I don't understand it, we will struggle to invest. So if it's what is that? Something where you're transmitting data through light, right? For example, it looks good. We will try and understand it. Beyond a point, if we don't understand, we will not invest in it, right? And we're reasonably smart people. It's not that we don't understand deep tech. I don't want you guys to get the wrong view, but we are not a deep tech focused fund. We are an enterprise tech focused fund. Very often, given the stage we participate in, it turns out to be deep tech. But when you look at some of my investments, some of them are not deep tech. They are frankly shallow tech, but they are deep value to an enterprise. Right? So tech can be shallow, but if it's deep value and you can build stickiness, we're good, right? Because you can build a scalable business. I mean, you don't take that. It's meant to make a point. But yeah, otherwise, if you guys have ambition and you're good founder teams with intellectual integrity and honesty, then we'd love to work with you and your friends.
Perfect. So I think, Rajiv, thank you so much once again for joining us.